Hi, my name is Ray.
Hi, this is Michael.
And welcome to another episode of Ray's Economics Cluebook. Today we're talking about the excise tax and total surplus in private markets. So what is the excise tax? Excise tax is basically a tax we see often put on things like tobacco products or vices or just heavy tax, basically often compared to a lump sum tax, in which it's basically a per unit, it's exact tax.
Yeah, basically it's based on some transaction. Per transaction, they may charge a flat dollar, like $10 per pack of cigarettes, right?
Well, usually not $10 per pack, but more like per se maybe 10 cents or so per pack.
And excise tax usually is state administered. So New York excise tax on cigarettes is far higher than Virginia, for example.
And along with that, New York also put similar taxes on soft drinks or unhealthy products, unhealthy food products. And so excise taxes, although not the exact same necessarily in this case. So excise taxes, basically, as Michael mentioned, are a per unit exact total tax. And what happens is that this provides the most simple analysis on an ADS model, on a demand-supply model. And so we see here tax revenue, right? We see if we put a $10 per unit tax onto tax revenue, then we see supply curve always shift left because of higher costs and lower overall sales. And so supply plus tax is shifted to the left by $5 this time proportionally, and so our original equilibrium in the private market was 5,000 units at $100 per unit, and now at the new tax, the supply curve shift and the demand supply curve shift, it becomes 4,000 units sold at $105 with a $10 excise tax per unit, and so we see here, originally we had surplus. We already knew what surplus is in the past, so our total surplus in the past was essentially total consumer surplus plus total producer surplus.
Yeah, it's pretty simple,
Which basically equals your lowest possible producer value, 75, times the difference between that and the overall market equilibrium price, 100. So 100 minus 75.
Then times the height.
times the length, which is an amount sold in the equilibrium, which is 5,000. This is 25 times 5, or 5,000, and divide by 2 because it's a triangle. And on the consumer side, it's 125 minus 100, minus 100, which is of the same 125 times 5 again. And then so we see here, this overall, this one big triangle is total surplus on the original market. However, excise taxes distort surpluses. So we see here, with our new surplus, our new consumer surplus starts here because our new market equilibrium is 105. And so our new height is 125 minus 105, which is 20. Times our new length, which is 4,000 now is sold, so it sells 4. Divide by 2, of course. And our new
that's how we get 40.
And for producers, if producers are paying the price of the excise tax, they sell at 105, they pay a tax minus 10 is 95 now. So their actual profit from it, or actual revenue from it, is 95.
That's what exactly sellers receive, because sellers collect the tax they have to turn in.
So they receive 95 instead of 105 because they pay a $10 excise tax. So their overall length of the producer surplus in this new excise tax market is 95 minus 75, which is 20 again, times their unit sold is 4. And so we see here our consumer and producer surplus is reduced. However, we have a new equation, and that's Uncle Sam, the government, and he's here to take his share. And this is his share right here, tax revenue. Tax revenue, because we see here tax revenue, the length is, the height of course is 10 because that's the excise tax amount per unit. And so it's the difference between what the producer sells to the consumer and what the producer actually receives post-tax because they pay the tax. And 10 times, or 10 per unit times total number of units sold, which is 4 in this case. And so we see here 4. So 10 times 4, or 4,000, creates $40,000 tax revenue in this hypothetical market. However, you might have noticed that there is a certain gray area here. And what this area, I'll draw a little better, what this area is here is our deadweight loss. Our deadweight loss is just loss. This is just gone. This overall surplus is gone. It's not used as tax. It's not consumer surplus. It's not producer surplus. It's what this excise tax takes away from this market, essentially. Because there's no factor or recipient of this surplus. It's just removed because of the tax. The tax eliminates this part of the market. And so this efficiency total surplus is now gone, and it's called deadweight loss. And it's 5 in this scenario.
Yeah, and it's pretty easy to calculate. If you understand geometry, it's so straightforward.
And we see here basically, in order to calculate it, basically you just look at the original height, which is now 1, and the original and the original length, which is 10, because that's the excise tax amount.
Yeah.
And this is 1, because we see here difference between the quantity sold, which is 5 in the original market and 4 in the new market.
Yeah.
And then divide by 2.
Yeah.
So, what is another factor of elasticity? We talk about elasticity is how responsive a certain producer market or a consumer group of consumers are to price changes.
Sure.
So if you're inelastic, that means no matter the price change will not affect your quantity, demand, or supply. If you're elastic, then it means the opposite. The price change causes a large change of price causes a large change in quantity, supply, or demand. And so we see here, if in terms of demand, if we have elastic demand right here, we have the elastic demand curve right here.
Yeah.
Then we see here, our overall tax burden is shared less on the demand consumer side and more on the producer side.
Yeah.
Why? Because we see here, if we look at here, if we draw a line through equilibrium, then our new demand, the amount of consumer deadweight loss on the demand side is a lot lower here than it is on the producer side, which is pretty apparent visually.
Yeah, as long as we understand geometry and can graph those correctly, it's so obvious.
Yeah.
So
But we see here, if the opposite is true, if we have inelastic demand where deadweight loss is more shared on the consumer portion right here than it is on the producer portion right here.
Yeah. Yeah. Go ahead.
And so as a result, we see here that the opposite, the same is true for supply. If we have a very inelastic supply, then we see here once again the tax burden is shared here more on producers than consumers.
Yeah. Actually, it's same as it's just a flip side of the same coin. So when we look at intuitively, it's very easy to understand. If we go back to the previous slide, then we can see the cigarette, right? So if we look at the cigarette part, then it's pretty obvious because think about it. When the excise tax increased and the cigarette smokers, they are so addicted, so they must buy it. They're still doing business. Okay, so and then they basically, so that's why even the price goes higher, the inelastic demand, insensitive demand determines that they are still going to do business like usual. That's why they have to share, they have to pay more share of the burden for the increase of excise tax. But on the other side, if we have an inelastic supply, just like the slide we just see that, for example, like downtown parking, right? I'm the owner of the downtown parking lot. Okay, but I must do the business because there's a limited space available and I'm already kind of like caught up in here. Okay, so even though the excise tax increase, I have to absorb most part of the excise tax.
And we see here if the supply curve is more elastic, then we see here the consumers share a larger portion of the deadweight loss, and the suppliers or producers share a lesser portion. And so essentially, as Michael mentioned, whoever, whether consumer versus producer, whoever is more elastic in their curve, demand or supply curve, shares an advantage in the tax burden because they share a lesser amount of deadweight loss. So more elasticity means a lesser amount of deadweight loss and a more likely chance at a tax advantage if you're more elastic than the opposite party.
Yeah, in reality, actually, the government really likes to put excise tax on inelastic business. For example, cigarettes, right? Inelastic demand. For example, downtown parking. That's exactly what happened in reality because they know those inelastic supply or inelastic demand, they're still going to stay in business. Okay, even if we put some more excise tax. So that means they're going to still collect the tax revenue. It's more predictable tax revenue, right? From cigarette smokers and from downtown parking owners. Okay, and they are restricted. They're either addicted or restricted for various reasons. And they're still going to do business like usual. Okay, even if the cost is higher. So that's why excise tax are more likely to be, observed in those kind of inelastic demand or inelastic supply, size. Okay, so.
So for final clues, basically government interventions like the excise tax, they, as we mentioned, distort our economic surpluses. They reduce overall surplus and distort the amount of consumer and producer surplus, and Uncle Sam comes in and takes a piece for himself as tax revenue. However, the worst part of it is that it generates administration costs because the execution of these taxes have a lot of costs, which add into overall market inefficiency. Also, deadweight loss was mentioned. Overall surplus loss does not go to the government, does not go to consumers, does not go to producers. It's just gone. It's just it disappears because of the tax. And so this part of the market is now gone, eliminated by the tax, and that that causes even more market inefficiency. And so basically, elasticity of demand and supply determines share tax burden, meaning that whoever is more elastic has tax advantage because they have less deadweight loss, or they suffer less surplus loss, and as a result keep more efficiency proportionally.
And finally, I would like to say, as we just mentioned for numerous times, graphics are the keys.
Indeed.
Okay. Yeah. Really, when you can graphic those kind of correctly and understand those graph and the geometry, the whole microeconomics becomes much easier to understand and to grasp. Okay. So see you next time. Bye bye.